Imagine walking out to your mailbox on a completely normal afternoon, flipping through grocery ads and utility bills, and then noticing an official envelope from the IRS. Your stomach tightens. You open it, expecting a routine notice at most. Instead, you're staring at a $10,000 penalty. And the worst part? You have absolutely no idea what you did wrong. You didn't hide money overseas. You didn't run a secret business. You didn't cheat on your taxes. All you did was deposit some cash from selling your truck. Or maybe your daughter gave you money to help with medical bills. Or you moved some funds around so you could finally replace that old roof. Completely normal retirement activity. But in 2026, normal doesn't always mean safe. Because what's triggering these penalties isn't clear criminal behavior, it's patterns. Patterns flagged by automated systems that don't know your story. And once that system decides something looks suspicious, the penalties can start at $10,000 for a single violation. Today, we're going to unpack what's actually happening, why so many retirees are being caught off guard, and the one simple mistake that can turn an innocent bank visit into a federal problem. Hi, I'm Artur, and I spend my time helping retirees protect the nest egg they worked an entire lifetime to build. I need to talk to you about something that has quietly changed in the financial world this year. The rule behind all of this is not new. It's been around for decades. But how it's being enforced in 2026 is very different, faster, automated, and far less forgiving when anything in your financial picture doesn't line up perfectly. My goal today isn't to scare you. It's to help you understand what's really going on, what kinds of everyday banking activity can trigger a huge penalty, and, most importantly, how to protect yourself so you never face that $10,000 shock. Because once you see how the system actually works, you'll realize the danger isn't obvious at all, and that's exactly why we need to talk about it. Let's start with the part that's catching people completely off guard. Everyday transactions that look totally harmless. Picture this. You sell your old pickup truck for $15,000 in cash. The buyer shows up, counts it out, and you go straight to the bank and deposit it. Simple. Or your son wires you $20,000 to help cover unexpected medical expenses. Or you finally decide to take that lump sum pension payout. Or you move a large chunk of savings from one account to another because you're putting a down payment on an RV. None of that is illegal. None of it is shady. It's just life in retirement. It's your money. But here's where things start to shift in 2026. Banks aren't just holding your deposits anymore. Certain types of activity are reported automatically. And those reports don't sit in a file cabinet collecting dust. They're scanned, sorted, and cross-referenced by systems specifically designed to find inconsistencies. So when a large amount of cash suddenly appears in your account, the system doesn't see truck sale, gift from daughter, or pension payout. It sees numbers. It sees patterns. And if those patterns don't match what's on your tax return or in your other financial records, the system raises a digital eyebrow. From your point of view, you're just managing your finances responsibly. From the system's point of view, it's asking one very precise question. Where did this money come from, and was it reported properly? If that answer isn't crystal clear in the data it can see, that's when problems begin. Here's the twist that surprises almost everyone. The rule behind this isn't new at all. It's been in place for decades. What's changed is how aggressively, and how efficiently, it's being enforced now. At the center of this is something called a Currency Transaction Report, or CTR. Despite how technical that sounds, the concept is simple. By law, banks are required to file a CTR anytime someone makes a cash transaction over $10,000. That includes cash deposits, cash withdrawals, and some kinds of cash transfers. So if you walk into your bank and deposit $12,000 in cash, the bank fills out a report and sends it to the government. You don't fill it out. You may never see it. It happens automatically in the background. And here's what matters. A CTR is not a penalty. It's not an accusation. It's not a sign you've done something wrong. Millions of these reports are filed every year. For a long time, this has been routine. Business owners deposit cash. People sell cars. Families move money. The bank files the form and life goes on. So if that's been the law for years, why are retirees now hearing about $10,000 penalties? Because in the past, a lot of those reports just sat in databases, unless a human investigator had a reason to look more closely. Today, that's no longer how it works. Now, CTRs are fed directly into automated systems that compare them against your tax returns, Social Security records, pension distributions, and other financial data. The system isn't just gathering information anymore, it's actively analyzing it in real time. When it finds something that doesn't line up, that's when the trouble starts. And there's another layer to this that's even more dangerous than simply making a big deposit. It's a mistake that well-meaning people make all the time, thinking they're being smart or cautious. In the eyes of the IRS, that one decision can turn a completely legal transaction into a federal violation. Here's where everything changes, and where a lot of honest, law-abiding retirees accidentally step into dangerous territory. Let's say you have $12,000 in cash. Maybe it's from selling a boat. Maybe it's savings you kept at home. Maybe it's money you've had for years and never deposited. You walk into the bank, and right before you get to the counter, a little voice in your head says, "If I deposit all of this at once, they'll report it. I don't want any extra attention." So instead, you deposit $8,000 on Monday, then come back on Wednesday and deposit the remaining $4,000. From your perspective, that feels harmless, maybe even responsible. You're not hiding income, you're not dodging taxes, you just don't want extra government paperwork. That seems reasonable, right? Under federal law, that decision completely changes the situation. This is called structuring. Structuring happens when someone intentionally breaks up a large cash transaction into smaller amounts for the purpose of avoiding the $10,000 reporting requirement. And here's the part that catches people by surprise. The money itself doesn't have to be illegal. It doesn't matter if it came from your pension, the sale of personal property, or a family gift. If the deposits are split specifically to avoid triggering a CTR, that action alone can be treated as a federal violation. Penalties for structuring can start at $10,000 per violation. Now, let's contrast this very clearly because it's critical. If you walk into the bank and deposit $12,000 in cash in a single transaction, the bank files a CTR. That's it. Routine, legal, no crime, no penalty. In most cases, nothing further happens. But if you intentionally deposit $8,000 and then $4,000 specifically to avoid that report, you've just created a pattern that automated systems are built to detect. And those systems are very good at spotting patterns. They look at timing. They look at amounts. They look at the sequence of transactions over several days or weeks. If it looks like the deposits were structured to stay under the reporting threshold, that's when red flags escalate quickly. And here's the uncomfortable truth. The system doesn't know your intentions. It doesn't understand that you were just trying to avoid extra attention. It only sees the pattern. And the pattern is what matters. This is where so many good people get into trouble. They think they're being cautious. They think they're staying off some imaginary radar. In reality, breaking up deposits to avoid reporting is exactly what puts them on the radar. So let me say this as plainly as possible. Having a currency transaction report filed on your deposit is not a problem. Actively trying to avoid one can be. This is the shift happening in 2026. With advanced automation, cross-referencing, and real-time analytics, these patterns are no longer slipping through the cracks. The system doesn't need a person at a desk to notice you. It flags inconsistencies instantly. It connects deposits to tax returns. It compares reported income to cash activity. And when something doesn't line up, notices go out automatically. Before you let this spiral into anxiety, take a breath. The IRS is not targeting retirees who are simply managing normal, well-documented finances. The overwhelming majority of people who deposit money properly, even large amounts, never hear a word about it. The real danger is misunderstanding the rule. So here's your first major takeaway. Never split a transaction just to stay under $10,000. If you have more than $10,000 in legitimate cash, deposit it in a single transaction. Let the bank file the report. That's what the system expects. That's what keeps everything clean. If this is already helping clarify things for you, take a second to like the video and subscribe. I share updates like this specifically to help retirees avoid expensive mistakes before they happen, not after. Because now that you understand structuring, we need to talk about something just as important. How to protect yourself going forward. What simple habits can make sure that, even in this fully automated IRS environment, you're never left scrambling to explain your own money? That's what we'll cover next. Now that you see where the real risk is, Let's shift from awareness to protection. This isn't about panic, it's about preparation. The enforcement landscape in 2026 may be more automated, faster, and less forgiving of inconsistencies, but the way you protect yourself is surprisingly straightforward. You don't need complicated legal strategies or clever loopholes. You need organization, clarity, and a solid paper trail. Step 1, and this is the most powerful, document everything. Anytime a large sum of money moves in or out of your accounts, you want records that clearly show where it came from and why. If you sell your car for $15,000, keep a signed bill of sale. Make a copy, scan it, and store it somewhere safe. If your daughter gives you $20,000 to help with medical expenses, ask her to write a short gift letter stating the amount and that it's a gift, not income, not a loan. If you take a lump sum pension payout, keep all of the distribution paperwork. If you withdraw cash for a major purchase or project, keep invoices and receipts. The goal is simple. If anyone ever asks, you can immediately produce proof of the source and purpose of the money. Here's what most retirees don't realize. The IRS computer doesn't automatically know the context behind your transactions. It only sees numbers. Your documentation provides the story behind those numbers. When that story is clear and backed by paperwork, any questions that do come up tend to resolve much more quickly. Step 2. If your financial life is even moderately complex, more than just Social Security and a small pension, this is a very good year to sit down with a qualified tax professional. A good CPA doesn't just file forms. They help make sure your tax return tells a complete, consistent story. If you had a large deposit from selling property, that needs to align with what's reported. If you received a sizable gift, they can help you handle it correctly. Automation flags mismatches. A tax professional helps prevent those mismatches before they exist. Step 3. Communicate openly with your bank. This surprises people. There's no harm in asking your bank how they handle large cash deposits and reporting. In fact, transparency works in your favor. If you're planning to deposit a large amount of legitimate cash, you can simply do it properly and let them file the required CTR. Remember, a currency transaction report is routine. It is not an accusation. Trying to avoid it is what creates risk. When you combine these 3 habits, strong documentation, professional guidance when needed, and transparency with your bank, you dramatically reduce your chances of ever facing that $10,000 surprise. Now let's put this into perspective. The automated systems in 2026 are powerful. They connect dots instantly. They cross-reference deposits with tax filings. They identify patterns that human reviewers might miss. But they're still data-driven machines. They rely on consistency. When your records are organized, your transactions are straightforward, and your tax return reflects your real finances, you're operating exactly the way the system expects. This is not about hiding, it's about clarity. And if you know another retiree, a friend, sibling, or someone in your community, who still thinks breaking up deposits is a smart way to stay under the radar, share this with them. A simple misunderstanding could cost them $10,000 or more, because the truth is, the financial world has changed. The old way of doing things, where small inconsistencies might slip by unnoticed, is disappearing. We now live in a fully digital enforcement era, and the people who adapt early are the ones who avoid unnecessary stress. Here's the bigger picture you need to understand. The enforcement shift we're seeing in 2026 isn't a temporary experiment. It's not a pilot program that will quietly go away next year. Automation is now built into how financial oversight works. The systems are faster, more connected, and always running in the background. That means the retirees most at risk aren't the ones doing anything blatantly criminal. They're the ones relying on outdated assumptions. For years, many people believed that if something didn't raise eyebrows at the bank counter, it probably wasn't a big deal. If you kept deposits small, stayed under the radar, and handled things quietly, you were being cautious. In today's environment, trying to stay under the radar is exactly what can create your radar signature. That's the irony. One clear $15,000 deposit with proper documentation, routine, logged, processed, forgotten. Multiple smaller deposits, intentionally timed and sized to avoid reporting, pattern detected, flag triggered, questions asked. The system isn't emotional. It doesn't automatically assume guilt. But it does assume that patterns meant to avoid reporting deserve extra scrutiny. And once that scrutiny begins, it can be stressful, time-consuming, and expensive to resolve. Now, I want to bring this back to reassurance. Most retirees will never face a structuring penalty. Most large, legitimate deposits, when done properly and supported by records, move through the system without any issues. The point of this isn't to make you nervous every time you walk into a bank. The point is to replace uncertainty with clarity, because clarity changes your behavior. When you understand that a currency transaction report is normal, you stop fearing it. When you understand that structuring is about intent to avoid reporting, you stop accidentally creating risky patterns. When you understand that documentation tells your financial story, you start building the kind of paper trail that protects you by default. This is ultimately about mindset. The old mindset was, keep it quiet. The new mindset needs to be, keep it documented. That single shift can save you a lot of stress. So here's the question I want you to seriously consider. If a fully digital IRS system reviewed your last 12 months of financial activity, would your story make sense on paper? Would every large deposit have a clear explanation you can prove? Would movements of funds line up with what's reported on your tax return? If the answer is yes, you're operating exactly where you should be. If the answer is, I'm not sure, then now is the perfect time to get organized. To file paperwork properly, scan and store documents, sit down with a tax professional if needed, and clean up anything that feels unclear. Not because you're currently in trouble, but because preparation is always far cheaper and far less painful than penalties. You worked decades to build your retirement savings. You sacrificed. You planned. You made careful decisions so you could enjoy this chapter of life with security and peace of mind. The last thing you want is a preventable $10,000 penalty caused by a misunderstanding of how bank reporting works. The rules themselves haven't radically changed. What's changed is the speed, visibility, and automation behind enforcement. And the retirees who thrive in this new environment are not the ones who panic. They're the ones who adapt. So, deposit large amounts properly. Never split transactions just to stay under $10,000. Keep documentation for significant financial events. Make sure your tax return reflects your real financial life. And treat transparency as protection, not exposure. When your financial paper trail is clear, organized, and consistent, automated systems have nothing to question. And that's where real peace of mind lives.